Red or green, what is the next candle going to be? In this video, I'll show you how to predict the price movements and how to do efficient chart analyses. We are starting here on the daily time frame where we want to do our analysis, and then on the lower time frame we want to look for entries. So when we look at this chart, what do you think? Will the price go up or down from here? You can pause the video to analyze the chart and come up with an answer. And here I have a really important tip that can help you avoid a lot of bad trading decisions. And my first tip is that you do not trade into a support and resistance level. On the higher time frame at this point of the candle, I think it looks a little bit more bearish than bullish, right? The market has been going down. When we look even further left, it seems like the market has been in a longer term downtrend. However, the market is so close to the ultimate low of this previous trend that trading into this support level would be a huge mistake because those levels are often holding. So at this point, I would say overall it's a little bit more bearish than bullish, but I would not bet on more bearishness and I would definitely not go into a short trade on the lower time frames. Now, what do you think? And now we can apply the same analysis. It is looking more bearish than bullish. The last candle was red. The one before that was quite a large red candle, an engulfing one. It looks overall bearish, but do you want to get into a short trade just yet? I don't think so, and I would not recommend that you're looking for shorts when you're trading into a very important major support level. So we're just waiting one more candle. And now everything changes because now you can see the market had a breakout attempt. You are probably very glad that you didn't jump into a short trade. Although it looked good at the beginning of the day, the market pulled back all the way and then closed as a pin bar. And now let's analyze this pin bar and see what we can learn. And there's some really fascinating insights here. So we're looking at this pin bar here and we're zooming in. And there are two very important price levels for this pin bar. It is the highest point and there's the lowest point. And the lowest point is the end of the wick and the highest point is the high of the day. So now we can come up with a really good trading plan. And for a bullish trading idea, we want to wait for the market to break the high. And for a bearish trading idea, we want to wait for the market to, as we say, cover the wick. There are other YouTube videos where traders are referring to as eating the wick, which is also a really fascinating concept. You can search that on YouTube and you will find some really good videos. So now we could say, okay, we want to look for a break of the high for a bullish trade idea. And that would make sense because a bullish trade idea, when we take out the high of the candle, it would signal that this pin bar is then looking like a fake out, and it means that the support level held, and we could look for a bounce away from the support level higher. For a bearish trade idea, we want to make sure that the market is eating the wick. Until the market has really covered the wick to the downside and has fully taken out the low, I would not look for bearish opportunities. Although this means that you have to wait a little bit longer for your trade, it is typically a good idea, and over time this will most likely save you a lot of money avoiding early trade ideas. So now what we do is we go from the daily time frame to the 1 hour time frame where we want to come up with trading plans and then time our trade, get into a trade, put our stop loss and our target in. So when we go to the lower time frame, what do we see? We see here the short-term support was support here. The market made lower highs. We broke below it and now it might be retesting as resistance. This overall is our pin bar on the higher time frame. We have the opening, then the market moved lower and was rejected and we closed here at the very high. And this is really important now to observe. We are now in a range market. This is a neutral market. As long as the market is trading within the boundaries of the candlestick pin bar that we are seeing, it is a neutral market and I would not recommend to do anything. However, now we can come up with a trading plan. We wait for the market to take out this area here, or we wait out for the market to take out the low here. A bullish trade would be triggered here, a bearish trade would be triggered here. And both trade ideas, the long and the short, would make a lot of sense in the terms and in the context of the higher time frame. Now, waiting just a few candles longer has provided a much clearer trading idea and has provided a much clearer picture of the whole situation. I know a lot of traders will now say, but I have to wait a long time and I want to trade more. However, if you've been trading for a while, you will notice when you look at your trading results that trading less often, waiting a little bit longer for actually a much clearer entry signal will most likely improve your trade quality a lot, and you will often take just bad inferior trades if you are not waiting. Now we can see we have inverse head and shoulder. The left shoulder, the head is the low of the pin bar, and the right shoulder is here. This is what we also call a pressure or a breakout buildup. The market moved into the resistance and it didn't reject the market didn't move lower quite a lot, but the market really stuck to the level. And then we see the breakout, retest, and we are taking out here the high. At that point, this is a high probability long entry because the higher and the lower time frame are really fitting together very nicely, and they tell you the same story. And then afterwards, you can see we have the breakout, we have another retest here of the neckline from the head and shoulders pattern, and then the market rallied higher. And when we go now to the higher time frame to see what this looks like, you can see this is the pin bar that we have observed at the previous support level. We have the strong breakout, the retest, this is what we call an inside pin bar. The market tried to rally lower but was rejected. Then we take out the high of the pin bar on the next candle and continue higher. Where's the uptrend ending? It is ending here at this previous support area. Here's also a supply and demand area. And what you can see now is in the evening star pattern, we have the gap higher, we have a neutral candle, and then we have the signal that is giving you a very bearish outlook. So now you can repeat the game on the higher time frame and you can continue the higher time frame game. What do you think? Will the market go up or down? At that point, I think it makes a lot of sense to look for bearish opportunities, and it might not make a lot of sense to look for bullish continuations. And then you can go to the lower time frame and look for trading plans once again. But I want to take a look at another example, and we want to take a look at a pin bar with a different context. We are again here on the daily time frame. This is our higher time frame, and even if you are a day trader and you take your trades on the 1 minute or on the 5 minute time frame, I think it's always a good idea to, at least at the beginning of the day, go to the higher time frame, analyze the price situation there, look for the important levels, and see what the most recent candlesticks have shown you. What do you think? Will the market go up or down? What do we see? The market is in a clear uptrend, and to the left we don't see any important resistance areas. So here we are in an overall bullish environment and the market looks really interesting. But do you want to go long just yet, going against the pin bar here, going against the long wick? I don't think so. And typically what you do is that you draw your high and your daily low around the extremes of the pin bar candlestick, and you want to avoid trading within the range here. You don't want to go long until the market has cleared the high, and you don't want to go short until the market has taken out the low. And this is a really important, very simple trading plan idea, but it can help you avoid a lot of mistakes that I see many traders make when it comes to pin bars. A pin bar is not automatically a rejection signal, and it should not automatically mean when you see a pin bar that you go short. You have to wait and see what the market is doing and then go to the lower time frame to fine-tune your trading plans. What do we see here on the next candle? The market tried to take out the high but was rejected. We do have a green candle, the market would have gone up, but on the lower time frame we would have seen a lot of volatility, and probably a lot of traders would have made a wrong call. So the market didn't take out the high, we didn't close higher, we are still here between the range, and waiting was the right call. The next candle is again an inside candle, now even smaller. And you can see we are staying within the range of the previous one. You are probably very glad that you have waited. Although the market does look overall a little bit more bullish than bearish, waiting for the market to decide what is it going to do after this important pin bar signal is the key here. Now you can see we get the final signal. We see that the market is able to take out the wick. We're also taking out this wick from the previous candle, and we are finally getting out of the range. At that point, it makes sense to go to the lower time frame, to the 1 hour, analyze the price action, and then look for continuations. And what is interesting, when we go to the lower time frame, this is a lower time frame fake out. This is this candle here that we have seen after the pin bar. A lot of traders would have gone to the lower time frame and taken this fake out, and then they would have ended with a loss because the trade was not ready. The price action was not agreeing. The market has not taken out the pin bar high yet. But here it looks really different. Now the candle, as we've seen, the high and the large daily candle has taken out the previous highs and has also retested the previous resistance as support. At that point, going into a long or waiting for another pattern is a much higher probability play than just jumping onto a pin bar when you see it. What we can see just shortly afterwards is another retest. We have a breakout and a retest. Some traders may have jumped onto this long entry, which is not a wrong call, and some traders, when they talk about immediate retests, this is what they're looking for, and this could have been a signal. However, other traders may want to see a delayed retest. They're also coming quite often, and then you get another entry signal. Or maybe you've missed the first entry signal and then you get a second chance. And it's always better to wait for a valid second entry signal instead of chasing the market. You see, we have the entry stops, you have a lot of options. You can put it under the breakout candle, you can put it here under the second one, the moving average, or you can put it all the way below the support and resistance level. And then you're trading with the trend. The market did move quite a lot higher and the market would have gone up. And this, you can see, resulted in a much more pleasant trading experience. You don't have a lot of volatility, the market moved higher, and compare that to what has happened here after the fake out. After this situation, we can go back to the higher time frame to see what it looks like. And now you can see this is the pin bar where we started. This is the trigger that took out the highs, that confirmed our bullish bias. And then you can see after this large candle, the market would have gone up afterwards. And now we can continue the game. Now we can see a lot of wicks, and with no candle afterwards has taken out any wick. And this is a really different picture because now it shows us we have a lot of weakness in the market and we don't want to get long until the market is clearing the wicks. Taking out wicks is a really important, very simple, but very effective concept that you can apply in your trading, and it will often save you a lot of troubles.